Geoffrey Woglam. And I hope I'm pronouncing that correctly. He's Professor of Economics Emeritus at Amherst College, where he taught for over 40 years. And during his career, he's been a consultant at the Federal Reserve Board and the International Monetary Fund, and held visiting positions at Harvard, Cambridge, LSE, and Nanjing universities. Now he's going to be talking to us about the national debt, and it's pretty timely considering it just passed through Congress. So Geoffrey, you can take it away.
Well, thank you very much, Mary Jane. One of the things that was both fun and annoying about being a macroeconomist is you always had to redo your notes because there was always something new. And boy, is that true when I'm giving these talks on debt and deficits. As you probably are aware, what was it yesterday that the American Rescue Plan passed? So I'm going to try to give you as much up-to-date information as I can. There's lots and lots of interesting stuff to talk about, but the fun part for me is when we do the Q&A. So I've tried to cut the slides. We have a little bit of work to do before we can get into the more interesting stuff. I've tried to cut these slides to a minimum. They will be posted on the NEED website, and if you're interested, you may want to take a look at it. You can see all the slides that didn't make it into the talk if you want as well. So without further ado, let me start by sharing the screen. Yeah.
I'm not sure that the club knows what the NEED website is. Can you explain your organization?
Yeah, that's the first few slides.
Oh.
So I'll be right there. Can you see those slides? Whoops, can you see the slides? Yes? Okay, great. So NEED is the National Economic Education Delegation. It's located, John Haveman is located fairly close to you guys. And he formed this organization to try to provide people with public lectures on economic issues from a nonpartisan basis. He has an enormous number of delegates, people who participate, both domestically and overseas. Two former Fed chairs, I hope you know Janet Yellen, because she was a former Federal Reserve Bank of San Francisco president. She's also Biden's Secretary of the Treasury. Most importantly, she was my TA in graduate school, so I have a lot of respect for her. There are lots and lots of different topics. If you like, you might want to talk to John about scheduling another talk on a variety of these topics, and this is just a small selection. Okay, let's jump in. So this was the fiscal 2020 budget of the federal government. I'm going to be talking about federal debt. There were $340 trillion in tax revenues. Outlays were 6.5 or 6.6 trillion. So the budget deficit ended up being a little bit over 3 trillion. We spent about 3 trillion more than we raised in taxes, and the rest we borrowed. That's not unusual. This is a graph that is showing you, and don't worry about the two purple lines, just focus on the black line. That's all I'm going to care about. This is a graph that shows you as a percentage of GDP total deficits. And it starts in 1971, and you can see that there's this brief period where the government budget was actually in surplus. That is the end of the Clinton administration. And then here's the projection. And as you can see, the projection is for very, very large deficits. But it gets worse. These projections do not include the effects of the American Rescue Plan. The CBO that I'll talk a little bit more about in a second provided some new information that I combined with the other information. And this is now what the projections are going to look like. 2019 and 2020 are the actual deficits. And you can see we ran almost a 15% of GDP as a deficit in fiscal 2020. But instead of the deficit going down in 2021, the deficit is actually going to get worse. And it's almost 16% of GDP. This is the good news, I guess. The deficit is not the largest we've ever had. But the other time the deficit was this large was in the height of World War II. Okay. Debt versus deficits, kind of important. The debt is the accumulated value of all past deficits and surpluses. So it's the total amount that has been borrowed to finance past government spending in excess of tax revenues. So on the left-hand side, I have the deficit, and this is just in absolute dollars, and that's graphed by the red line. Okay, and you can see that deficit increases enormously as we go into 2020. And the blue line is what's happening to the total value of the debt. It's slowly increasing until the end of the 2000s when it starts to go up, and then it goes through the roof. At the moment, the shaded areas in these graphs are recessions. Okay. Let me go back again. So the total debt is somewhat north of $20 trillion, which is about the size of the economy. The CBO has this wonderful chart that they did, unfortunately, before the explosion in debt and deficits, but it still has the relative percentages are roughly correct. It breaks down the debt into two categories. The debt that's held by other government branches. This is primarily, as you can see, Social Security. And then there's the debt that's held by the public. It's called the debt held by the public, not by another branch of government. This is also interesting, much different than when I started my teaching career. 40% of the debt is held by international investors, and only 39% is held directly by domestic investors. And then there's a breakdown of the Federal Reserve and state and local governments. By the way, the Fed's slice of this pie would be much, much bigger currently. A lot of people like to know, and this, by the way, again, when I started teaching this, there was virtually no debt that was held by foreign countries, or the amount was very, very small. This actually shows that relative to 2009, foreign holding of the debt has gone down. So we're looking at the shares of US public debt that are held by foreign nationals or foreign central banks. And Japan and China have been leading the list for quite some time. To give you a specific number, Japan holds about 1.25 trillion US denominated debt, and China is about 1.07 trillion. Okay, so now we got to start to think a little bit about what is the debt we care about in terms of what it might have some cost. And some debt reduces the availability of funds that could be used for productive investment. That's sometimes called crowding out. So we worry about public debt crowding out private investment. Intragovernmental debt, things like the Social Security Trust Fund, is very important for bookkeeping and for the future course of the actual deficit, but it doesn't currently crowd out private investment because it's one branch of government borrowing from another branch of government. So it has no net effect on the current amount of investable funds. The debt held by the public, in other words, the total debt less this intergovernmental debt, is the debt that may crowd out private investment. Most analyses of the federal debt focus on the public debt, the debt held by the public. Here are the two concepts. You can see that the total debt is almost 28 trillion, and the debt held by the public is about 21 trillion, and the vertical distance is the Social Security and Medicare trust funds primarily. oh, I guess I quoted this already. The debt held by the public at the moment, you can actually get a daily treasury statement. So I looked up the latest one I could find is for March 9th. The debt held by the public is 21.8 trillion, which is slightly more than GDP. Okay, I've mentioned the CBO. The CBO is really a jewel of the American government. It is a think tank that was formed in 1974 to provide Congress with budgetary information about pending legislation. And it is a long history of nonpartisanship and very highly regarded amongst the economic profession. It issues two kinds of reports. I was almost going to change this because they have a very recent estimate. The graph earlier I used where they were showing you the effects of the American Rescue Plan on the deficit. But they do other things which are a little bit more, can generate even more interest than that. They analyze the budgetary effects of Raise the Wage Act. When there was a discussion as to whether or not the minimum wage should be raised to $15, there was a number quoted, 1.4 million jobs lost, estimated by the CBO. That was in this budgetary estimate. They also do, for Congress's benefit, they do budget and economic outlooks. They do a short-term 10-year one, and then they do longer terms that goes out 30 years. Another technical point, I've only got one more technical point after this. The CBO analyzes the debt relative to GDP, because the extent that debt and deficits are going to have costs is going to be dependent upon how big the debt is relative to the size of the economy. To try to make this point, these are the numbers, the latest numbers I could get for Greece. Greece has a tiny debt relative to the United States, but it has a much, much more severe debt problem because it's almost twice the size of the Greek economy, whereas in 2019, it was only 80% of the US economy. So from here on out, I'm going to be primarily talking about relative debt and relative deficits, relative to the size of the economy or divided by GDP. So there you go. That's a typical chart that the CBO generates. And to save time, they actually have one that goes back to the Revolutionary War. To save time, I'm just going to give you this one because there are two periods that I want you to pay some attention to. From 1946 to 1974, the relative debt falls almost continuously, okay? The other period, which I'm going to talk about at the end, is look at the projected one. Now, you might even start thinking about that as a little bit of a puzzle. I showed you relatively high deficits, right? But still, they're projecting that the relative debt is not going to start accelerating until the middle part of the 2020s. We'll come back to that later. So, relative debt peaked and then was a steady decline. Prior to 1983, and this is the part that the graph doesn't show very well, the relative debt rose for economic reasons. I'm going to shorthand that and say purposely. We used it to finance the war. And instead of trying to come up with the resources all at once, we spread it out over time, which makes sense. We also had increases in the relative debt during recessions. Automatically, income tax revenues go down during recessions. Unemployment compensation goes up during recessions. And that tends to cushion the economy. Those are good reasons to have a higher deficit and an increase in the relative debt. But that's all the history prior to 1983. Starting in about 1983, the relative debt has been and is expected to continue to rise for the next 30 years without a strategic purpose. So we're in new uncharted territory in a lot of ways. Last technical point. We want to understand how is it that the relative debt fell in this period in spite of the fact that there were deficits in 21 of the 29 years. And during that period, the total debt outstanding increased by 42%. To understand that puzzle, you have to go back to your 10th grade arithmetic or algebra. I don't know, I guess this is earlier than that. But in any event, the relative debt is a fraction. And the fraction will fall. If the numerator falls, that would be a budget surplus. Clearly, that wasn't terribly important. Or the denominator rises. That's when the size of the economy or nominal GDP gets bigger. A fraction will also fall when the denominator is growing faster than the numerator, or put into words, when GDP is growing faster than the debt outstanding. From 46 to 74, the deficits caused the debt to grow, but not as fast as GDP. While the debt grew by 42%, GDP grew by 550%. So the technical point that I want you to understand is we don't need a budget surplus to stabilize or to reduce the relative debt. Okay, so now we're going to go back to my classroom circa 1978. And I would have to talk about the debt. And the first thing I would do is to say, look, politicians are always telling you and trying to draw an analogy between households and government debt, and it's totally inaccurate. Households have to pay their debt back or declare bankruptcy. The government does not have to pay the debt back. When retirees cash in maturing bonds, that's financed by new bond issues, by the Treasury selling more bonds to younger people. So what's going on is essentially the interest on the debt is being paid by the young to their parents. But don't worry about it, because the young eventually become parents and old, and the process continues. So the government debt does not have to be paid off, as long as the Treasury can always sell new bonds to replace the maturing bonds. So after giving that speech, I would say, now look, basically you should stop worrying about the debt because it has very little cost and it's been falling. So it's not a problem. Well, that changes in '83 because it starts to rise. So this is sort of the mid-'80s when I would emphasize, well, if the household analogy is not right, what are the true costs? And the answer is this crowding out. But crowding out works through higher interest rates. So what we were concerned about is that the higher the deficit and debt levels, the higher the interest rates, and that would discourage private firms' investment, leading to a smaller capital stock over time and reduced future output. So it was the loss in the capital stock and future output that was the cost of running a government debt. Once the foreigners got into the act, I also had to talk about the fact that the higher interest rates would lead to what are called foreign capital inflows, which essentially amounts to foreign borrowing. We're borrowing from foreigners to finance our trade deficits. And with the foreign borrowing, some of our GDP is being paid to foreigners as interest. Okay, that was the 1985. There are a couple of other minor points, but that's basically the point I was trying to get across with my students. But as time went on, there was a problem with that. So again, the shaded areas are recessions. The blue line is the 10-year Treasury, and that's graphed on the right. The red line is the relative debt. And there's a problem with my analysis, which was that rising relative debt should cause rising interest rates, which would crowd out private investment. But what happened to interest rates? They fell. So something is wrong, or something was going on that we had not taken account of. Things change all the time. The debt numbers, the last I can get is 2020. Starting in the beginning of the year, the 10-year rate has risen by about a percentage point. You may have been reading about it in the paper. The bond markets are getting nervous. Okay, So something didn't work in our traditional view. Olivier Blanchard is close to Nobel Prize winning territory and I wouldn't be surprised in the next 4 or 5 years if he doesn't get it. By the way, you have to be alive. So as long as he's taking care of his health, I think he will get the Nobel Prize. He's an MIT economist, was the head of the chief economist for the IMF, and a very, very smart guy. He was the president of the American Economic Association in 2018. And as the president, you give a speech in January, the first meeting of the new year of the American Economic Association. And at that meeting, he gave a talk about debt and deficits. And this is a quote, if the future is like the past with low interest rates, the issuance of debt without a later increase in taxes may well be feasible. Put bluntly, public debt may have no fiscal cost. This shook things up a little bit. Now, he needed to be careful. My purpose is not to argue for more public debt, especially in the current political environment. It is to have a richer discussion of the cost of the debt than is currently the case. In other words, we're talking about the cost of the debt in terms of crowding out and foreign borrowing, but that all depends upon interest rates, and they're not rising. By the way, we don't know why they're not rising. That's a little bit of a problem for this analysis. But in any event, Blanchard is arguing that we may be overstating the cost of relative debt. So, what did the traditional view get wrong? Stabilizing the relative debt requires that the growth rate in the debt is equal to the growth rate of GDP. The denominator grows at the same rate as the numerator. The growth rate in the debt has two parts. One part is just the interest rate on past debt. Okay, that's going to lead to growth in the debt in the future. The other part is a contribution that depends upon what are called programmatic outlays less total revenues. Programmatic outlays are everything the government spends on except for interest on the debt. Now, the traditional view, if the programmatic outlays equals revenue, the debt would grow at the interest rate. That's to help a little bit. The traditional view assumed that the interest rate on the debt was going to be greater than the growth rate of GDP. So what that meant is if you balanced outlays with programmatic outlays with revenues, the numerator would be growing faster than the denominator because the assumption was the interest rate on the debt would be higher than the growth rate of GDP. But so that's the conclusion from the traditional view. But what happens if the interest rate is less? Then if you had programmatic outlays equal to total revenues, the debt would be growing more slowly than GDP and the relative debt would be falling. So the bottom line is that you can have a small deficit in programmatic outlays and still stabilize the relative debt. Now, Blanchard does believe that we have to stabilize the relative debt. And that means at some point, the deficits that we're running and we're projected to run must be reduced. But what he's saying is it may not be crucial at what level of debt we stabilize. In the 1980s, if you told me we had a debt to GDP ratio of 100%, I would faint. What Blanchard is saying is get a grip, Professor Woglam. It's not that bad. So here's his evidence. The blue line is that 10-year Treasury rate, and the red line is the growth rate of GDP. So for Blanchard's case to be true, you need the blue line to be less than the red line, and it isn't in this period. But since 2000, and except for recessions, the red line, GDP growth, is consistently above the blue line. Okay. Well, some people have said, gee, that's great. We don't have to worry about 100% GDP. Why do we have to worry about any level of relative debt? Why do we have to stabilize it? And they point out to the fact that for practical purposes, the US, by the way, as opposed to Greece, cannot default on its debt because the debt is denominated in dollars, okay? Greece can't print euros. The US, by the Fed, can print dollars. International, so domestic, you don't have to worry about your government bonds defaulting. But if you're overseas, even though the government bond a US government bond can't default, you will lose if the exchange value of the dollar falls. Because you care about purchasing power in yen or yuan or euros. And it could be that the exchange value of the dollar falls. In that case, the US bonds might be a very bad investment. This is important because you have to remember that 40% of the debt is held by foreigners. So why do foreigners hold US treasuries in the first place? Well, the answer is that the market for US treasuries happens to be the deepest and usually the most liquid capital market in the world. I had to add that parenthetical expression because we are coming up on a 1-year anniversary where the Fed had to step into the treasury market because all of a sudden, for a lot of technical reasons, liquidity disappeared, which is what scared the heck out of the Fed. And that was, I think, the week of March 15th of last year. The other reason is that the US economy has a history of political and economic stability. So you need to put your money someplace, and the safest place you can put it is in the US Treasury market. In addition, the dollar is the largest international reserve currency. What this means is there are lots and lots of international transactions that occur in dollars. For example, oil. Oil is quoted in dollars and it's traded in dollars, even though a lot of it's produced in foreign countries. With some exceptions, believe it or not, foreigners borrow in dollars. Now, I'm from Massachusetts and I don't like the Yankees, but in this case, Yankee bonds can refer to a foreign government that's borrowing in dollars. So they're called Yankee bonds. I'd rather have Red Sox bonds myself, but. So you have to ask yourself, 40% of the debt's held by foreigners. What would happen if the foreigners lost confidence in the stability of the dollar? Well, so you don't think I'm the fear monger. I'm going to let you know, I'm going to quote the CBO. And this is, I think I don't know whether I put the reference, but in any event, this is a recent publication. Concerns about the government's fiscal position could lead to a sudden and potentially spiraling increase in people's expectations of inflation, a large drop in the value of the dollar, or a loss in confidence in the government's ability to commitment to repay its debt in full. The risk of such a fiscal crisis appears to be low in the short run, despite the higher deficits and debt stemming from the pandemic. Nonetheless, much higher debt over time would raise the risk of a fiscal crisis in the years ahead. So there's the reference. By the way, what we're talking about is a run on the dollar caused by our enormous federal debt. What would that look like? So the foreigners lose confidence. They sell their treasuries in exchange for assets denominated in their own or other currencies. The sale of the treasuries raises interest rates, worsening our fiscal outlook. But that should be an hour. The trading of foreign assets for US assets by itself will lower the exchange value of the dollar. This raises the price of imports, increasing inflation, and it lowers the foreign currency returns on all US assets, and that causes a vicious cycle. Could the Fed bail us out? Well, it could buy treasuries to prevent the rise in interest rates, but it does not have enough foreign assets to prevent the fall in the exchange rate. So What's the prospects of a fiscal crisis? This is the CBO's crystal ball, and you're going to have to look at it and judge for yourself how serious this problem may or may not be. The blue line is what the CBO projects will be GDP growth. The red line is what they project the interest rate on the debt will be. And for reference, I've put the black line is their forecast for the relative debt. Now, by the way, do you remember I asked you to remember that projection for the first part of the 2020s? It's hard to see here, but the relative debt is almost stable. If anything, it's falling a little bit until about 2026 when it starts to go up. Now, boy, I wish I had you in person. This graph is going to show you why the CBO made those projections. Can somebody raise their hand? These are just like my Amherst College students. Nobody raises their hand? Well, there's GDP growth, and there's the interest on the debt. GDP growth is way above the interest on the debt. So even though we are running enormous deficits, the relative debt is not going to grow until about 2026. And you can see why it accelerates. I mean, it accelerates because we're building up more debt, but in addition, because of this forecast for rising interest rates. Now, I'm sure that the CBO would tell you that they put a lot of time and effort into forecasting what was going to happen to the interest rates. But I want to tell you, forecasting the interest rate in 2051 is a fool's game. Who the hell knows what the interest rate is going to be in 2051? Maybe interest rates will stay low. Maybe they'll go through the roof. Economists have some ideas as to why interest rates are low. It may have something to do with foreign savings. Japan and China save a lot. The aging populations in the industrial world. There are lots of speculations, but the plain facts are we don't know. And if you take that interest rate forecast and notch it up a percentage point, it gets a hell of a lot worse. So the bad news is this does not include the American rescue plans. I don't have those data in this graph. I'm sorry, we already talked about the 2021 projection. That's that part here. We don't get an increase in the relative debt because GDP growth is so much above interest rates. So bottom line, you guys going to get to talk, I hope. We do need to worry about the debt. Interest rates may not stay this low forever. And again, I've tried to impress upon you that we don't know why they're this low to begin with. And we have to avoid a fiscal crisis at all costs. The good news is we may be able to stabilize the relative debt without running a surplus, at least until 2030. But we must substantially reduce deficits after the pandemic. The CBO, again, back in September, suggested that they're hoping the pandemic would be over by this point, and we should reduce projected 5% deficits by a half. Okay, it won't be easy. So I hope you can see this. It's not too small on your screens. This is the composition of federal outlays today, or 2019, and 30 years in the future. The first thing is that 92% at the moment is programmatic stuff, okay? By 2051, because the relative debt's going to increase by then to almost 200%, we are spending 27% of total spending on interest. Now, interest you can't cut unless you default, and you don't want to do that. So here's where you get to operate. The non-interest spending, Okay, discretionary spending already is going to go from 33% of the non-interest spending. These are the programmatic stuff, down to 24. Other mandatory spending, 14 to 8. And there you go. Medicare, 28. Medicare, 41. Now, how we solve this problem is a political question. But I'm going to try to point out to you what I think is a nonpartisan point, that healthcare costs have to be gotten under control. And by the way, we have to also raise revenues. Okay. There's the website for if you'd like to see these slides, that they'll be up either later tonight or tomorrow. I'd be happy to answer your questions both in over email, or I hope now. And I always like to end one of these talks with a famous quote by Herbert Stein, who was the chief economist for Nixon, who's, believe it or not, is famous for saying the following thing: if things can't go on forever, they usually stop. That's insightful, because the question is, how does it stop? Does it stop with a fiscal crisis? Does it stop with somehow controlling medical care costs? Does it stop with raising significantly more revenue? Those are the key questions. So please, I'm done. Please ask me some questions. Is there a moderator who can turn people's mics on?
I have one, if I may.
Yes, please.
I'm curious, when you talk about the interest rate on the debt, is there an easy answer to that? Is it the 2-year, the 10-year, the 30-year treasury, something like that? And part B, I work at Morgan Stanley, and our folks are thinking in the short term that the 10-year is probably going to go up to about 1.7% by year end. Do you have any agree, disagree, any thought on that?
Well, Cully, is that your first name?
Yes, sir.
You can call me Jeff, Cully. I think your Morgan Stanley forecast is in not too much trouble, even though I don't like the forecast. You know why? The 10-year treasury has already hit 1.6.
Yeah.
So that looks like a pretty safe projection. I happen to believe, now we're not talking, this is my professional opinion. This is not necessarily the consensus. I think that the fiscal stimulus package was too big. And and I think that either that's going to crowd out, the infrastructure is not going to be as large as they want, or they're going to overheat the economy. And as you may or may not know, there are measures of inflationary expectations built into interest rates, and those are headed up. Even though, and there was an inflation report either yesterday or the day before, there is zero inflation at the moment. But the combination of rising demand and possibly rising inflation, I think the 1.7, as long as I don't have to come back, I think the 1.7 is too low.
And how about how the rate, or what is the rate that you referred to on the rate of interest on debt? Is it a simple?
The interest on debt, believe it or not, and I'm glad I don't have to do this. The CBO looks at the I want to say term structure, but that's the maturity structure of the debt that's outstanding. Okay.
So it's a blend of all
that.
of it.
And that interest rate that I showed you, by the way, I should stop sharing my screen. Did someone do that for me? Yes. The interest rate that was in that graph, the crystal ball graph, that was their estimate of the interest on the debt.
Okay.
So.
Thank you.
Ron.
It's estimated today that the state of California's share of this latest 1.9 trillion is going to be about $150 billion to the state of California, in addition to the state already being over, having a budget surplus of, I think, 20 billion or something like that. What do you think is the best way that the state can use that money without overwhelming every man, woman, and child in the state?
You ask easy questions. That's interesting. I saw that report as well. And can I sort of elaborate? I don't want to be a politician and answer the question I want to answer and suppose the one you did, but let me elaborate a little bit on this. One of the problems, it's easy to say that the 1.9 was too big, but what would you cut? Well, one of the things that a lot of people would cut is the aid to state governments, because while we thought the states were going to get clobbered, and many did, there were others that didn't. So you are quite correct that from reading the newspaper as you did, that California's got a budget surplus. And yet they're getting of the state and local part of the stimulus, they're going to get $22 billion in spite of the fact that they're running a surplus. But you know what? They've cut employment. So some of it is that they've cut employment, and you need to get some of those workers back. I would hope that they would build up their rainy day fund, restore, don't spend it frivolously. And other than that, I don't know enough about California, Ron, to advise you.
Thank you.
I have a question.
Great.
On one of the last slides you showed, it showed that the GDP was like relatively flat for about 20 years.
Yes.
Why is that?
Okay, because we don't forecast, nobody can forecast a recession. So what the CBO is doing is that they're forecasting what they think inflation will be and the real growth in the economy. It's called the full employment growth in the economy. Do you understand that when they do that forecast, if you noticed, it was bumpy to begin with, because we're clearly coming out of a recession. But once you're out of the recession, we don't forecast my God, we can't forecast GDP a quarter out, but trying to forecast recessions in the future, you can't do. Does that make any sense?
It does. But so if the GDP was going up, it doesn't make things as dire? Is that?
Yeah. The problem is it's not going up fast enough. And some of that, by the way, that's another sort of long-term problem with regard to the Social Security issue, because technological change has slowed down and the labor force is growing much more slowly than it has in the past. And both those things mean that GDP grows more slowly, and that makes all these problems worse.
Thanks.
Yeah.
Jeff, how do, if states were to put some of that money into repairing our infrastructure and doing that sort of thing, how does that affect? I mean, if the country, we're falling apart. What if we actually use that money to fix the country? Would that?
I don't know whether California, obviously there's some infrastructure that California is responsible for. And I think that's a good answer. I wish I'd come up with it for Ron. Yeah, you should do something like that. If you've got projects that you haven't been able to get to for budgetary reasons, use this windfall to do that. Let me say a little bit about, a lot of the infrastructure like the interstate highway system, broadband, are national issues. And that's why this debt and deficit and the stimulus package has been so widely debated. Some of the slides I had to cut, you can read them tonight if you want to. In December, Larry Summers and Jason Furman, Larry Summers is a famous economist, Jason Furman was the chair of, I think, Obama's council. They were arguing for large-scale stimulus, infrastructure investment financed by debt, and they were using Blanchard. We can afford it because so what if the debt goes to 150% of GDP? The infrastructure will more than pay the interest on the debt. But infrastructure investment is stimulus. So you might be surprised that Jason Furman was supportive of the Biden bill and Larry Summers was writing articles saying it's too big. And what they're afraid of is, if you overheat the economy, if you put too much stimulus in, you're going to cause inflation, interest rates are going to go up, and God knows what's going to happen at that point. So it's a really interesting question. And that's why you had Democratic economists debating whether or not really this 1.9 trillion is too much. Now, the problem, and I'm going on too long, but the problem is politically, What did Biden run on? I promised households $2,000. And politically, that would be the toughest one to cut. The other one, by the way, that the Republicans wanted was to do away with the $350 billion for state and local aid. Well, yeah, California may not need it, but I can tell you Nevada, Hawaii, and Texas do. And how do you draft legislation that provides money for one state and not the other state? Obviously, politically, it'd be impossible. So it's a very good question.
What exactly happened in the 70s and the 80s where we got into double-digit inflation? Has that been analyzed? And is that the kind of possibility you're talking about?
Yes, although, you know what, again, I'm not predicting it. And the world has changed. And these are very, very, nobody really understands. Why have we had such moderation in inflation? Now, what I'm smiling because up until 2008, there were a whole bunch of economists, and by the way, they have a name for this, the Great Moderation. Inflation came down, business cycles were less severe. And you know what they decided? It's because we've taught central banks how to behave more appropriately. Well, that sort of went out the window in 2008. But I'm old enough to remember the Vietnam War. And I used to like to tell students that inflation is a little bit like toothpaste in the tube. It's easy to get it out, but it's pretty hard to get it back in. And boy, did we have trouble getting it back in. Now, the 70s were a very, very difficult decade, but essentially Paul Volcker put the world economy into a recessionary shambles. Higher unemployment than in the Great Recession and the latest pandemic to cure inflation. We don't want to do that again, and I'm nervous about that. So now, I should give you the other side of this, the Janet Yellen side, is that monetary policy has the tools to prevent an overheating in the economy. But the problem is the tool is raising interest rates. And then all these numbers that I've been showing you get worse.
Jeff,
You're looking at your watch. I've overstayed my welcome, I think.
Jeff, may I ask a question?
You may.
In all these calculations, the population growth, where does it go? How do you calculate that? Because every day we have more children and more people are going to need jobs. And so I don't understand how that is calculated. Even the United Nations make some mistakes in the growth population, the population growth in the world.
Well, Pablo, the easy answer for me is I don't do it, but the CBO economists and demographers do it. And they look at the age composition of the population, and they look at changes in fertility and all sorts of things. And you might have been suggesting that population growth is a problem. In fact, population growth is too low. And by the way, Romney has this bill where he wants to, the primary reason for it is he would like to see more rapid population growth. And also an issue that might be of interest to you guys in California is, another way you could get the labor force to grow besides having more babies? Immigration. Immigration is a very, very difficult issue. And I don't think you should do immigration. You should decide on how much immigration we have based upon these issues alone. But allowing young, qualified, skilled workers into our borders would help the problems that I've been discussing. By the way, John Haveman has a talk on immigration that's much more much more refined than the 2 minutes I just gave you.
Yeah, so you're right, Jeff, we're past our time.
Yeah.
So everybody has your email or has the information off that final slide. And we really want to thank you. 1 second, to show you here. We donate a book to the one of the middle schools, and this one is.
I can see. Oh,
show up
Hey.
just for you.
Well, thank you.
And it will have your name. There's a plaque, a Rotary plaque that goes in the inside with your name.
Oh, that's
And
fun.
so it's a little remembrance. So thank you so much. This has been really interesting, and it makes my brain itch. I'm sorry.
Complicated issues. But I
Yeah.
appreciate it. I have a lot of fun doing these things. So
Oh, the one thing that didn't get asked, and I hope if anybody's interested, we didn't talk about Bitcoin and the other currencies, what that's going to do to the dollar, because if the dollar goes, we're all.
you have to ask for another lecture. I can't tell you
Okay.
much about Bitcoin.
That's too big. Okay. Thank you so much. We really appreciate your time.
I'm glad you did. Bye-bye.
Thank you very much,
Thank you.
Jeff.
Thank you.